Welcome to the Mortgage Rate Weekly Market Update for the week of July 10th, 2017. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you your update. Well, last week, again, we saw mortgage rates move higher as mortgage bonds sold off. If you take a look at the bond chart on the screen, you can see the long-term trend here has been for mortgage bonds to sell off and move mortgage interest rates higher with the blue arrows there. So we sold off the previous week, sold off again this week. Now we did hit a floor of support with that horizontal blue line. Very important floor of support, because we break below that, there's a big run it can make lower for the bond market, which means moving interest rates even higher. There hasn't been a lot of bond-friendly news lately. That is why the mortgage bonds have sold off. So with the headwinds that the mortgage bonds are facing, which we're going to get into those in a minute, we're going to recommend locking your mortgage rate to start the week. Take advantage of the lower rates we've seen for most of the year. We are off the all-time low of 2017, but we're still, it's a low rate. If you're closing the next 30 to 60 days, lock your rate. Take advantage of the rate you got now, because in the next 30 to 60 days, we could definitely see rates move higher with what's going on in the bond market. Now, if we dig into the economic news, big report last week was the jobs report for June 2017. The number of jobs created exceeded expectations, 222,000 jobs created, well above the 170,000 expected. And they also revised the April jobs report and the May jobs report higher. So April was revised from 174 to 207, and May was revised higher from 138 to 152. So that part of the jobs report was very good. Now, we did see the unemployment rate tick up from 4.3 to 4.4%, but that was because we saw more people coming back into the workforce now that the number of jobs is being created is being more. So that is what moved it up. So the household survey, which is a different report, showed 245,000 jobs created, but 361,000 people entered the workforce that were not being counted in the workforce previously. That's why the unemployment rate ticked up. Now, we also saw the labor force participation rate ticked up to 62.8%. So that measures the number of people 16 years or older eligible for work that are actually working. So that's a good sign, moving in the right direction, that more people are coming back into the workforce. So overall, the jobs report was a good number. Unemployment's low. Jobs created above expectation. But mortgage bonds did not sell off like you would think on a good jobs report. And the reason why is we didn't have much wage growth. Wage growth continues to be stagnant, only 0.2% growth in June and 2.5% year over year. We need a wage growth of at least 3% to have some inflation, which is what would allow the Fed to continue hiking rates and would be an underlying good mover of the economy. So with wage growth below 3%, it's going to be tough for the Feds to keep hiking rates without any inflation. Now, bond yields in Europe was the other thing that is weighing on the mortgage bond market. And long term, this is why we're recommending locking, because we feel that the bonds can continue to sell off. Because in Europe, the sentiment out of Europe is the economy is improving in Europe. So mortgage bonds, not mortgage bonds, just the bond market in Europe has improved. For example, the German Bund has significantly moved higher from 0.22% just a couple of weeks ago to 0.58% presently, which is the highest since December 2015. If the German Bund continue to move higher, it'll make it difficult for mortgage rates to go any lower. They're probably going to move higher in step with that. And just remember, a year ago, the German Bund was negative 0.2%. So which means if you were putting money in that bond, you were paying money to park it there. Now it's actually giving you a return. The bond markets are doing very well, as the long-term outlook for interest rates in Europe is to move higher. As the economy improves, that's going to spill over here. We'll probably see our treasuries and our mortgage bonds move higher. So again, that's why we have that locking recommendation. Now, week initial jobless claims came out on Thursday, showed 248,000 jobless claims for the week. That was up 4,000 from the previous week, but still very strong number there on the labor market. That was the 122nd consecutive week of jobless claims below 300,000, and it's the longest stretch in 47 years. Now, moving into housing news. CoreLogic released its home price index for May 2017, which showed home prices were up 1.2% from April, and were up 6.6% from May of 2016. This was a slight decline from last month's from April's year-over-year appreciation of 6.9%, but still solid appreciation. CoreLogic's predicting 5.3% home price appreciation from May 2017, to May 2018, which means it's still a great time to purchase a home. Just a few months ago, the home price appreciation prediction was only 4.7%. So that has moved up even more, as we see housing is still doing very strong, low inventory, good job market. That's going to push home prices up. So if you're thinking about buying or selling, it's a great time to do it. Now, the median days on market for homes for sale, this is a great report to understand here, has continued to drop across the United States, and the average has dropped to 27 days. So that means homes are moving. Why? No inventory. We got a lot of buyers out there. The first-time home buyers actually made up 33% of the market, so that's pretty big for first-time home buyers. If you look at the infographic on the screen, you can see half the country is less than 30 days on the market for home sales. In the local market here, Delaware is at 31 to 45 days. Maryland, New Jersey, and Pennsylvania are all at 45 to 60 days. That's still a short time on the market. That means it's very competitive out there. You can't be lowballing houses or you're not going to get them. It's just not going to work. And in the local news, in Delaware, the state transfer tax is going up to 4% August 1st. So you need to get under contract prior to August 1st to be on the current guidelines of only 3%. Otherwise, it's going to cost you and the seller another 1% to sell that house. So that's a big motivator to get out there, get under contract. Don't quibble over a couple $1,000 because you're going to lose it in Delaware on August 1st anyway with the increased transfer tax. So still a great time to get out there and buy. In the local news, the next first-time homebuyer seminar is Saturday, July 22nd in Newark, Delaware at the Christiana Hilton Hotel from 10 a.m. to noon. You can register for that event by giving us a call at 302-703-0727 or online, DelawareHomeBuyerSeminar.com. If you need a fast, quick pre-approval, you need to close less than 30 days, give us a call or apply online at DelawareMortgageLoans.net. Look forward to seeing you guys next week.